Good afternoon, everyone. This is Dipti, host for today's webinar. We will start our session in 10 minutes. Thank you. Hello, Mr. Arun. Good afternoon, everyone, and warm welcome from Bigger. We begin to today's webinar session, and the topic is Learn Basics of Option Strategies. First of all, let me introduce myself. Myself, Deepti. I'm a host for today's webinar. And we are delighted to have today all, and we have an opportunity to introduce all to the Bigul. Bigul is a fintech division of Bonanza Portfolio Limited, which was previously known as My E-Trade. Bigul is an online trading and investment platform built for those who wish to pursue success. It is also an ecosystem for individuals who wish to trade like a pro. I would like to introduce to you today's speaker or a guest, Mr. Arun Mantri. Let me quickly introduce about him. He is a fellow member of the Institute of Chartered Accountant of India, and simultaneously he is a senior research analyst with the industry expertise, with the holding a 10 years experience with him into the field of technical research, portfolio management, and advisory. Hello, Mr. Arun. It's glad you are here with us to give our insights about the today's topic. I have a small instructions for the attendees that if they are having, before handing over the session to Mr. Arun, if they are having any questions and queries related to topic or any in general also, they can type into the chat box. Simultaneously, we are live with our Facebook, Instagram, and they can follow us with all our social media handles. Today's, once the session is over or the webinar is done, we are sending a survey form. We regards that a presentation that takes place today is given by, give us a feedbacks on that, and feel free to give us a open feedback to have a session to Mr. Arun as well. Thank you so much. Mr. Arun, I'm just handing over the session to you.
Okay, thank you very much. Am I audible?
Yeah, very much, sir.
Okay, sure. So let's start with the session.
Sure.
Okay, so today's session is basically on options. It is options and option strategies. So before going to options and the deep criteria how to deal with the options trading and all, let's discuss something about markets first, then we'll go to the trading of options. See, there has been a drastic change in the market, in the equity market from in the last 2 to 3 years. Post-Corona or post-2019 or post-2020, there has been many new traders who have joined the market, who are into the market now. The age group which has joined the market recently are from 18 to 28 years or 18 to 32 years. Those are the young blood who had started trading into the market. See, the major reason why the trading in the market have taken place in a very high momentum in the last 2 years is because of the options. Many people, they are more relying on the options in terms of trading. They have differentiated themselves from equity investing and investing regularly into the market. More of them are now into trading field rather than going into the investing. So that is why we have taken this topic today to discuss about options. I'll share my screen with you. I'll share my screen with you. See, today we will discuss mostly about options, how to deal with options, what are the options, definitions, what are the different kinds of jargons we should know before trading into the options. I know many people, they trade into the option by going and buying the options which are available at very cheap prices, but they don't know when to buy options, where to buy options, and how to deal with stop losses and targets while trading into the options. Now, I know 90% of the crowd who are in this webinar, they are dealing in options definitely. That is why they have joined this. See, there is a saying in the market in derivatives that 90% of the options, they expire worthless. I will use some Hindi terms also in middle because it will be very useful for you. आपको पता होगा 90% जो options होते हैं वो zero होके expire होते हैं during the expiry. And many of you know there are two types of expiry now. They are weekly expiry and monthly expiry. And people are mostly more fond of weekly expiries. And weekly expiry happens only in Nifty and Bank Nifty and also in Fin Nifty. So weekly expiry don't happen in stocks. First of all, it should be very clear. Options expiry which are weekly, those weekly options, they don't expire in stocks. Means stock expire only on monthly. So weekly options are only available for Bank Nifty, Nifty and Fin Nifty. And and the stock expiry is only available in terms of monthly expiry. So many people, they are more fond of doing expiry trades. They are more fond of doing bank nifty and nifty trades right now, and they are more fascinated to do it. See, I don't say options trading is bad. Option trading is very good, but if you do options trading without any knowledge, without any basic knowledge, then it is very harmful. It can erode your own whole capital also. I have came across various clients and some of my friends who trade in options. They keep 50,000, 1 lakh, 1,50,000 in their account, and they start doing buying options. I know options do give good returns as well. Sometimes a 25,000 worth of option, it turns out to 50,000 or 1 lakh as well. But most of the options, they expire worthless. If you don't buy options at the correct time and exit at correct time, your capital will be zero. And again, repeating, if you don't buy if you buy options without basic knowledge and without doing some research, your capital can become zero. In a single trade, you can erode your whole capital which you have invested. Given an example, suppose you have bought Reliance. You have bought Reliance around 2,000 rupees, 2,800 rupees at current level. You have invested 10 in 10 shares. So your shares are worth about 28,000 rupees. See, no doubt, if market comes down tomorrow also, if market comes down after 2 months also, your 28,000 will become 25,000 or 24,000. But in terms of options, your 28,000 can become zero in a month, and it can become 56,000 or 1,16,000 in a couple of days as well. So your risk is very high in options, especially in buy options and sell options both. So before choosing the field of option trading, do have a basic knowledge how to trade, because in terms of equity investing, you will not lose money immediately if market falls. You will lose in a slightly lower manner, and you will gain also in a slightly slower manner. So always, whenever you are investing, it is good. You should invest, but whenever you are trading, you should be very, very alert. Your trading can erode your entire capital in a single day or a single hour also. So let's start with the options basics. So before going to option, let's see what do you mean by derivatives. So you can see in my tagline here, it's all about what instead of why. See, many people, they come to options trade, they say why to trade in options, and what are the benefits, what are the demerits of option. But before going to why, let's see what are options. Then we'll go for why options. See, derivatives, as we all know, derivatives, options are part of the derivative market, and options are the part of derivative markets all over the world. So what is the history of derivative markets? In 1875, Bombay Cotton Trade Association started the future trade. That is a kind of one derivative market. In 1952, due to some various reasons, government again banned this derivative trading. In 1995, again options trading were lifted. I'm not talking about the electrical options. There are various other options which were traded in the market. In 1999, from 1999, pure options trading started in the market. That is in the Indian market, both in NSE and later in BSE. So from 1999, options trading was started, and it was full-fledged from 2000. So options trading, the history is very less, only 20 to 22 years the history is there. So options trading is a very new topic for market. Now, introduction to derivative market. Derivative are the most important innovation which has happened in the past few years. See, when if you see overall derivatives, the derivatives were introduced only to hedge. It was not introduced to trade. So many people who were dealing in commodities, who are dealing in various other precious metals like gold, silver, and various other commodities like agriculture commodities, rice, wheat, and everything, the derivatives markets were introduced to make them hedge. Suppose you bought 1 kg of gold today, and it has fallen to from at 50,000, it has fallen to 45,000. You are making a 5,000 rupees loss per 10 gram. So to hedge these, derivative markets were introduced. So nowadays people are more into trading rather than hedging. It was mainly introduced to hedge, not to trade. But 90% of the crowd currently, those are trading. They are taking trade to make quick profits in the market. So let's see how it is done. Now it has changed the whole way of operational of stock, commodities, and currency. See, a person who was there in 2015 or 2014, I don't remember this kind of volatility was there in the market. अगर आपने मार्केट 2014, 2012 या 2010 के पास देखा होगा, वहां पे आपको मार्केट में 200 से 300 पॉइंट की मूवमेंट निफ्टी में कभी नहीं आती थी. जो मार्केट का मूवमेंट होता था, it was mostly 50 to 100 points or 150 points in a day. But nowadays, the markets in a single day, they are moving more than 300 to 400 points. Can you tell me why it was? It is because of only derivatives. Because in the case of derivatives, both options and futures, they work together. So whenever there is a huge movement in the market, the movement will be very, very fast, and it will be very, very huge due to derivative markets because many parties are involved. So before 2012, 2010 or 2014, they used to see there was no big movement in the market, but into post 2019, 2020, you are seeing a gradual movement of 400 to 500 points in Nifty. So people are more fascinated towards this movement and they start trading in options. So you have seen this movement from last 2 years. I think this movement will be more aggressive in the coming years as well, because more and more people are interested in options and more people are going into the field of derivatives. So because of derivatives, only this kind of movements you are seeing in the market. See, nobody is an expert in the market. First of all, I want to make it clear, nobody is the expert. We can give you some guidance how to trade in derivatives, how to trade in options. It is about you who have to execute the trade. So we can give you the direction, we can give you the basics, how you should go and trade, what are the things you should keep into your mind, and what are the various jargons which are used in the market, which are used in the television shows, which you should know before going into the options. So for a new trader, my first advice will be, don't go to the options market directly, because options are very hazardous to your wealth as well as your health. So don't go to the options market directly. For a new trader or investor, first start doing SIPs, start doing mutual funds, then go for equity investing, direct equity into the stocks, and then go for options. So if you are new to the market, don't go directly into the options, go for the equity market first. If you are new to the equity market as well, go with the SIP or mutual funds. Start observing the markets, at least observe the market for next 2 to 3 months. Observe how it is reacting on news, observe how it is reacting day by day, then you will get a grip on market. So after going to the mutual funds, after having some experience in the equity market by investing directly into the stocks, then come to the derivative markets. Derivatives, first go to options or futures, but trade with less quantity. Now, what is derivatives? See, derivatives, I already told, options are the part of derivatives. There are 4 kinds of derivatives which are traded into the markets. First is the forwards. So forwards are no longer traded, and those are mostly very less contracts. It is a kind of oral contract or a contract without any standardization. So forwards, you can leave it for now. The other 3 most important types of derivative contracts are futures, options, and swaps. See, futures, everybody know, those are lots like Reliance, Nifty, Bank Nifty, everybody know how to trade in futures. So futures is a bit kind of easy trade where you can, not easy in case of wealth. I'm talking about in case of basics, it is very easy to understand. Swaps, everybody knows swaps usually happens in currencies. Any person who is an exporter or is an importer, those people used to they trade in swaps. Next are the options. Options are very typical kind of trading tools and trading activities which was introduced mostly to hedge, but it is now mostly into the trading. So futures, everybody mostly know about futures, how they are traded. Swaps, it is very easy, or it is very, you can say it is mostly used by exporters or importers to hedge their position. Forwards is no longer practically traded in market. It is usually traded out of the market, and those are non-standardized contracts. The most traded derivatives in the market is options. So let's discuss the basics of options. Before going to the basics of option, let's go for futures. See, a future contract is an agreement between 2 parties. You should know always futures and options both are the contracts, and these contracts have expiry date. This is the first difference you should know between equity and futures and options. Equities, there is no expiry date in equity. If the company closes, then only your shares will become 0. But in the case of futures and options, there is an expiry. So that is why the risk is very high if you are trading in F&O. But if you are trading in equity, your risk is low and your reward is also less. So always do differentiate between trading in equity and futures. See, what many people do is this in a bullish phase like 2019 or 2020, when markets bottomed and give a ferocious rally of more than 200 to 300%. People were more fascinated towards equity investing, and they said that money making is very easy. When they invested 100 rupees in 2019-20, their money have become 300, 400 till now. So they started becoming more fascinated toward equity, and they now started becoming more fascinated toward futures and options as well. So first thing you should be very clear, equity and F&O is a different game field. Investing in equity is not easy, but it is very much easier than F&O. If you are investing in equity, you can easily track those investments. You can keep it for long term, you can keep it for short term, the money will be with you. But in the case of futures and options, if you are trading in futures and options, you should be very, very careful. Your capital can be eroded in minutes, your capital can be eroded in hours, and even your capital can be eroded in days. On the flip side, you can make money also quickly, but it is very risky if you are trading options and futures without any basic knowledge. So that is why we have kept this webinar to just let you know what is the main basics of options and what are the things you should keep in your mind whenever you buy or sell options. See, in the case of futures, there are only 4 types of futures: stock futures, index futures, currency futures, and commodity futures. Stock futures, everybody know there are around 220 stocks which are currently in the derivatives. So those 220 stocks will only have the stock futures. Index futures, everybody know, Bank Nifty, Nifty, and Fin Nifty. These are the 3 index futures which you can trade. Third is currency futures. You can trade in pairs like INR, dollar. You can trade in currency futures. Fourth are commodity futures: gold, silver, crude oil, natural gas, all these kind of futures you can trade in the market. So future contracts are kind of contracts where there is a specific expiry date, and you have to expire the contract on that date. So it is also very risky to trade in futures if you are not ready or if you are a new trader into the market. So this is a very important slide. I think many of the people, they don't know what do you mean by expiry. I know all of you know about expiry. Now, why this expiry concept is very important. See, all the futures and contracts, the futures and options, there are the contracts, they do have an expiry at the last. I think many of you know the last Thursday will be the expiry of the every month. See, for the month of July, the last Thursday is 30th. So all the futures and options expiry into the equity market or into the F&O market will expire on last Thursday. If last Thursday is a trading holiday, it will expire on the Wednesday, that is the 1 day previous of the last Thursday. So many of you know that last Thursday is the expiry, but they don't know what is the logic behind it. The logic, I think everybody know about the settlement, how these equity stocks are settled. All the equity transactions in stock exchange are settled at T+2, that is trading day plus 2 days. So whenever there is, suppose you bought Reliance on Monday or today or Monday, your settlement with that contract will be on Wednesday. Suppose you bought 10 shares of Reliance on Monday, your shares will be credited on till Wednesday. So always there is a T+2 settlement in the case of equity market. That is why if you bought any shares on Thursday, or your settlement will be on Tuesday, that is after the T+2 working days. That is why the last Thursday of every month will be the expiry day, because you can't settle it on Friday of the last month. That is why they took the last Thursday as the expiry day. So you should remember all the contracts in the case of equity market who are having derivative contracts which are traded in NSE and BSE. All these contracts will be settled on the last Thursday of every month. And talking about the monthly contracts, in the case of weekly contracts, each and every contracts will be settled on every Thursday of every week. And weekly contracts are only of Nifty, Bank Nifty, and Fin Nifty. You can't trade in weekly contracts of stocks. Suppose you want to buy a weekly contract, weekly option of stock, you can't buy the weekly option of stock. And only options expire in weekly. Futures don't expire in weekly contracts. Everybody should remember this. Many of the people, they say they are having a confusion that futures also expire weekly. Futures options don't expire weekly. Futures contracts, they don't expire weekly. Futures contract expire only at the last Thursday of every month. Only the options which are listed on weekly expiries, they expire on Thursday of every month. And weekly expiry is of Nifty, Bank Nifty, and Fin Nifty only. There are no stocks which are having options weekly expiry. You should be very, very clear. If you want to trade in weekly expiry, you have to trade only in Nifty, Bank Nifty, and Fin Nifty if it is available. And if you want to trade in stock options, you have to trade in stock options in monthly expiries only. You can go and check it today. You will not find any stock expiries which are weekly. Exchange is ready with a plan to come with the weekly options of stocks as well, but till now there is no clarity when it will come. Till now, only index options are traded, and futures, it is a monthly expiry only. There is no weekly expiry for any futures contract. So again, I'm repeating, only the index options will expire weekly. There is no expiry of futures contracts for a weekly. And stock options, it is only monthly contracts are available. There are no weekly contracts for stock options. You should be very, very clear with that. Second is current month, far month, and mid month. So what are these three concepts? Suppose you are into the July expiry. July is the current month expiry. August is the mid month expiry, and September is the far month expiry. You should be very clear which contract you are buying. You are buying of the current month, mid month, or the far month. Mid month is a July. Current month is a July. Mid month is a August, and far month is a September. You should be very clear which month options you are buying or which month futures you are buying. See, many of you know a concept called rollover. Whenever suppose this next week is the monthly expiry so you will see many people there, they talk about rollovers on the TV. If you go to YouTube, if you go to any Twitter handle, market handle, they will talk more about rollover. What do you mean rollover is? You are rolling your position from current expiry to the next expiry. But you should be very, very clear that only futures contracts can be rolled forward. Option contracts cannot be rolled. You should be very clear. Many people are having confusion that rollover happens in options as well, but rollover don't happen in options. Only futures contracts are rolled over. If you want to roll the options, you have to buy the next month option, but the price will be completely different due to the time value. So it should be very clear. In the case of rollover, only the futures contracts are rolled over. Options can't be rolled over to the next expiry. If you are having a 2,900 call option of current month expiry, it will expire at current month only. If you want to buy 2,900 call option of next expiry, the price will be very, very high because the series is started. So it should be very clear. Futures contract can be rolled. Options contract cannot be rolled. That is why you should be very, very careful whenever you are dealing in options. See, it is rolled over from series to series, and it is only futures can be rolled. Roller cost will be there. Usually last month rollover happens. Last minute rollover happens. What you mean by rollover cost is when suppose you are having the Reliance future contract of July month. Suppose 2,800 is the current price. Next month price will be 2,810 or 2,820. You have to pay 10 to 15 rupees or more kind of cost for rolling your futures contract. That cost is rollover contract because you are paying 10 rupees more for holding Reliance futures for 1 month. So whenever you are rolling the option, you have to bear this rollover cost as well. That is 10 to 15 rupees of rollover cost will be there. And usually it is, I am seeing the market from last 2 years. Usually rollover happens more from Tuesday, Wednesday, and Thursday of the last month. So from in Monday, the activity will be a bit less, but from Tuesday, the rollovers will be more. Most of the people, they will be rolling over their futures contract from current month to the next one. So from Tuesday, Wednesday, Thursday, you can see the rollovers will happen. You will see the more volatility which will happen in the market. So it is not necessary for you to roll the positions every time. If you want to exit the positions current contract also, you can exit it. There is no compulsory for any trader to roll the positions. You can roll it or you can even exit at current market price of current contract as well. So the main purpose of this slide is you should remember rollover happens only in futures. Rollover don't happen in options. You should be very, very clear. So whenever you are buying options, you should be clear that you can't roll options. If you are buying the options of current month, your options will become zero or your options will expire worthless or your options will expire with some intrinsic value depending upon the closing price. So there is no rollover concept. Suppose you bought 100 rupees worth of Reliance options current month. Your next month options can be 200 or 300 rupees also depending on the strike price. So you should be very clear. You don't have any options of rolling the options to the next month. Only futures can be rolled. So you should be very careful while trading in options. Now, I have given all this story before coming to the exact options topic is because you should know what is the basic. Derivatives have four kind of contracts: forwards, futures, options, and swaps. Forwards are no longer traded in exchanges. Futures you can trade, options you can trade, and swaps you can trade. Futures are very easy to understand. Like you buy stocks in equity, you will buy stocks in futures in terms of lots. Swaps, again, it is more kind of a complex topic, and it is mostly traded by the exporters or importers to hedge their positions. Options are the most liquid, most kind of easy to trade, and most kind of fascinated topic for every individual currently into the market. Now, what do you mean by options? The option is a contractual agreement between two parties of the underlying asset at a predetermined price. See, always remember options derive price from their underlying asset only. If there is no underlying asset, there will be no value for the options. Now, what do you mean by underlying asset is, suppose you are buying the options of Nifty, your options value will depend on Nifty value. Suppose you are buying the option of Reliance, your option value of Reliance will depend on the volume or the value of the Reliance. Suppose you are buying the option of Bank Nifty, your option value will be decided depending on the momentum in on the value of the Bank Nifty. So many people, they say, why? I'll give you one live example. Many of you people are having the knowledge of Bitcoin, at least you know about Bitcoin. It has seen a drastic fall from the top. Right now, it is also below 20,000 rupees. It has touched 50,000 a few months back. The main reason why there is a panic in Bitcoin is because many people, or 90% of the crowd, they don't know what is the underlying behind Bitcoin. On which basis Bitcoin prices are going up and going down. If you talk about Reliance option, you can say because of Reliance movement, the stock price, option price is moving. If you talk about Nifty options, you can say because of the Nifty movement, the option price of the Nifty is moving. But nobody knows what is the underlying behind Bitcoin. So that is why many people, there is a panic selling in Bitcoin, and people are still searching what are the underlying asset which is there, which are deriving these Bitcoins. So that is why option prices are always derived from the underlying asset. If you're trading in Reliance options, always have a watch on Reliance price. If you're trading in Nifty options, always have a watch on Nifty price. Now, I will give you a small example. Always, if you're trading in Nifty, in your screen, always add Nifty futures and your option strike or the option which you bought. Because whenever there is a movement in the underlying asset, your options will also move. So many people, they do mistake. They only keep the options which they bought on their market screen. So don't do that mistake. Whenever you are buying the option, along with that option, keep the underlying asset also, keep the future of that underlying asset also. I'll give you a live example or a real example. Suppose I bought 2,900 call option of Reliance. That is, I am bullish on market. Call option is, it gives a buyer a right to buy. Put option is, it gives the buyer the right to sell. If I am bullish on market, if I am bullish on Reliance, I will buy the call. If I'm bearish on Reliance, I will sell the call. I'm not going into those basics. Suppose the current market price of Reliance is 2,800. I am expecting the price to go up in next 3 to 4 days. So I bought Reliance 2,900 call option of July month. Suppose the next month, July month. So whenever I buy the call option, I will keep Reliance cash price, that is what is the spot value of Reliance on my screen, and also keep the Reliance July future contract. What is the July future contract traded? Because options value, they derive their value from the futures. Futures, they derive their underlying value from the cash market price. That is what is the equity value of the Reliance current market price. So it should be very clear. Futures derive their value from the cash price. Options derive their value from the futures. Options don't derive their value from the cash price. Options always derive their value from the futures. Should not be any dilemma that options derive their value from the cash price. They derive their value from the futures. So whenever you are buying options, always keep the cash price and the future price of the underlying asset on the screen. Because if you keep on watching these three prices, you'll get an idea what is happening in the stock. If you keep only the strike price, you will not be able to know what is happening. You will only be able to see the MTM. That is what is my loss or what is my profit. So for a better option trading, whenever you are buying any call or put of any underlying asset, always keep the underlying asset cash price and the future price of the same underlying asset together, because that will give you expertise how stock prices are moving. Suppose you are bullish, you are buying a call. If you are bearish, you are selling a call, or you are buying a put, and vice versa also you can do. So that is the first basic requirement. I'm giving only practical examples because all these underlying jargons you will find on YouTube, you will find on any social media channels. And give you a practical example. Whenever you are buying options of any stock or any index, always keep underlying asset on the screen and also the futures of that underlying asset on the screen, because your option value will be derived from those futures and cash price only. It will not be derived by just seeing the market. So always keep these three together so that you will get a better expertise. See, these are the option terminologies. You should know this. You should be very, very clear with these terminologies. Then only you will understand the options very well. So we'll clear it for you today. See, underlying asset, I already told you, if you are buying the Reliance option, your underlying asset is Reliance cash price and Reliance future price. And Reliance future price you are getting from Reliance cash price. So underlying asset can be any financial instrument such as equity, currency, or any option contract. If you're buying a rupee future contract, and an underlying asset is a rupee dollar pair. If you're buying a gold in futures, the underlying asset will be the gold in spot. If you're buying a Reliance future or Reliance options, your underlying is Reliance price. So underlying is very important. If there is no underlying asset, there will be no F&O contract. The first and foremost is whenever you are buying any options, keep futures and cash price together, and do watch them. If you are doing a daily trading, do watch all these three together. You will get to know how trading is happening. Now, what is the strike price? This is the most important thing. The strike price. See, 98% of the crowd, they know how to buy, they know how to sell the option, but they don't know how to select the strike. See, whenever you select the strike, you have to keep three things into the consideration. That is, at the money, out of the money, and in the money. These three things we'll discuss in the next slide. Just keep it in your mind. Whenever you buy an option, whenever you are going to select the strike, always keep these three things in the mind: at the money, in the money, and out of the money. If you want, you can write it also. We'll discuss this in the next slide. Those three things are very important for you to make money in options. If you don't remember these three things, you will be out of the market in very short period of time. You will not be able to make money. Third is the spot price. I already told you. Your options value will be derived from futures, and your futures value will be derived from the spot price. That is the cash market price. So whenever you come across underlying asset, I already told you underlying asset will be the cash price or the future price. Strike price we'll discuss in the next slide. Spot price is the current market price of any asset. It can be stock, it can be index, or it can be commodity. Now premium. Everybody know whenever you buy options, you have to pay premium. There is the amount of money that buyer will pay to the seller of an option contract. Premium traded on the exchange is for a single unit. See, it is a kind of, you can say, suppose Reliance is trading around 2,800 and 2,900 call is somewhere trading around 20 rupees. If I am having a confidence that Reliance is bullish, Reliance is looking good, Reliance will come to 2,900 in the next few days. So what I will do is I will give it a token amount. It is a kind of token amount to the seller that whenever it comes, it will go to a higher price. I will sell it. So you are buying a option contract, whenever you buy a property, whenever you buy any asset like car, also you will give it an advance of 10,000, 20,000 for booking. So it is a kind of those advance, the premium what you are paying. If the stock price is taking on 2,800, if you expect the stock price to go to 2,900, you will pay a token amount that the stock price will come to 2,900 after some days. So I want to buy the stock. So that is the token amount is called premium. So that will be very less whenever you are buying an options. So there are two parties: option buyer, option seller. The buyer of an option contract is the person who has the right to buy or sell at the price at their strike price. If 2,900 don't come after a few days, your option price will become zero. You know that. You should be very clear. If you are buying a call option of 2,900 when the Reliance is trading around 2,800, and if Reliance don't come about 2,900 in this expiry, your option price will become zero. That is why I told you, whenever you're trading in options, you have to select the price, select the strike very carefully. If you bought 2800 call option, there will be some value of 40-50 rupees, because if Reliance expires around 2850, you will get 40-50 rupees of value. But if you have bought 2900 of call, your value will become zero, because 2900 does not come and your option price will be zero. So always when you're trading in options, keep in mind that futures and cash price is very important, and selection of strike is very important. If you are at the start of the expiry, suppose you are at the start of the July expiry and you are expecting a quick movement in the market, do buy a just out of the money call and do trade. I will discuss this in the next slide. Now, the next major important is open interest. Now, open interest is the total number of options or futures contract that are not closed. See, whenever you analyze the market on futures and options, open interest is the blood of futures and options. In the case of equity market, cash is the blood. If there is no cash, you can't buy any stock in the market. But in the case of futures and options, if you want to analyze the F&O market, open interest is the blood of the F&O market. Now, what do you mean by open interest is, whenever a buyer and a seller come together, they form one contract, and total number of contracts which are open in the market, that is open interest. That is the interest of the people which is open in the market. So if there is more and more open interest in the market, that means more and more people are interested in trading in the market. If there is less open interest in the market, that means less people are have opened their contract in the current series. So open interest is the total number of options or futures that are not closed, which are open. That means if there are 10 buyers, 10 sellers who have come into the market, those 10 contracts are still open. So whenever you want to analyze the open interest futures and F&O market, open interest is the first thing you have to see. How many contracts are open? Is there a more open interest? Is there less open interest? What are the number of contracts which are open? That is very important whenever you are going to analyze open interest. So I'm not going into the detail because we are not analyzing the market here. We are just understanding what are the jargons. Second most important is cost of carry. It is the extra amount of value which you have to pay to carry positions. See, I already told you, cost of carry is like you are paying a 5-10 rupees more to get a future contract. That is a premium what you are paying in for futures and options. So whenever you are buying a Reliance option, suppose Reliance is trading on 2800, whenever you are buying a July month option, that is the next month, you have to pay 5 to 10 rupees more to get that contract. That cost is called cost of carry. So whenever you are trading in futures, you have to pay this cost of carry because you are getting the to open that future contract for 1 month. So you are paying a kind of rent for 1 month to carry the contract. That is called cost of carry. Now, what is contract size? See, I know many of you people are trading in futures and options, but there is a rule. There is a minimum criteria given by SEBI is a contract size will be minimum 5 lakhs. That is not minimum 5 lakhs. Its lot size will be depending on the contract size of 5 lakhs. Suppose the Reliance contract price somewhere it will be around 250. The 250 into 2800, that will be the contract size. So the contract size, the formula is current market price into lot size, that is the contract size. And the lot size will be decided depending on the contract size of any stocks or any index. So before Nifty used to trade, Nifty used to have the lot size of 75. If you remember before Corona period, Nifty was trading with a lot size of 75, but right now the lot size is 50 because the contract value have increased. If you go, Nifty was somewhere around 12,000 before 2018, 2019. Right now it is somewhere around 16,000. So the lot size in the current market price have increased, so the contract size have increased. So exchanges have reduced the lot size. Again, I will repeat the formula for contract size. It is current market price of the stock into the lot size. The Reliance is trading at 2800 into 250. That is a lot size in futures. That will be the contract value. So again, I will repeat all this. Premium is the extra token money what you pay in buying the options. There are two parties: option buyers, option sellers. Expiry. See, for every contract there is an expiry. All the futures and F&O contracts of every month will expire on the last Thursday of every month. Open interest, I already told you, whenever there is one buyer and one seller come together, there will be one open contract, and the total accumulative total contracts which are open in the market forms open interest. Open interest will be different for every stock. If there are more people who are trading in Reliance, there will be more open interest. There will be less people who will be trading in ITC. So there will be less open, always there will be less open interest in ITC. So open interest is a kind of blood for F&O. Cost of carry is the extra amount what you pay for carrying the contract for 1 month. That is the premium you want to pay. Contract size is current market of the stock into the lot size. That is the contract size. Now, what are the parties to the contract? See, there are 4 parties to the contract to options. First is the call buyer, second is the call seller, third is the put buyer, and fourth is the put seller. Again, in a simple terms, I will repeat: call option buyer and put option buyer, the loss is limited. Because if you are buying something for a limited value, the loss will be only what you have paid. Suppose you bought 100 rupees of 100 worth of premium of Reliance options into 250. So 25,000 is the total amount what you have invested in that call option. So if you bought a call or bought a put, your maximum loss will be 25,000 because you can't lose more than that. But in the case of seller, you can lose more than what you have invested on what you have also, because the loss is limited in the case of option sellers. Suppose you sold the option is 100, your options can go to up to 1,000 or 1,200 also, depending on the momentum. So whenever you are selling options, be very, very careful. Selling options is not an easy thing. You should have a good expertise. You should be on the screen throughout the day. So whenever you are selling the options, be very careful because you can lose what more than what you have invested. So the crux of this slide is option buyer have a limited risk and maximum reward, unlimited reward. Option sellers have a limited reward and unlimited risk because you will get only the premium value as a profit and your risk will be unlimited depending on the market condition. This rule applies both for call and put. If you are buying a call or buying a put, the risk is limited and the reward is unlimited. But if you are selling a call or selling a put, your risk is unlimited and reward is limited to the premium what you have received. So for a new trader, it is my gentle advice not to sell options in this market. Never go and sell these options, sell options without any hedge. If you know how to hedge the option, then only go and sell. If you don't know how to hedge the options, how to deal with the naked sell options, don't go and sell options nakedly. If you want to trade in options, go for buy options where your risk is limited and where you can lose what you have invested. But in the case of sell options, you can lose more than your invested value as well. So always remember, in the case of buying options, your risk is limited, reward is unlimited. In the case of selling options, your risk is unlimited, reward is limited. New trader, avoid selling options. You can go for buy if you have generate some expertise, and for even for a expert investor also, don't go for sell options without any hedge. So these are the 4 contracts which are there. Now this is a very important slide. This will give you the total crux. I'll go one by one. Suppose you are a call buyer. This is the first slide. A call buyer is extremely bullish. That is the first criteria you should be having, that you are extremely bullish on Nifty. Suppose current market price of Nifty is somewhere around 15,700. I know Nifty will move higher. I know Nifty, I'm extremely bullish on Nifty. So I'll go and buy a call of that Nifty. I can buy any call 15,800, 15,900, 16,000, depending on the market condition and depending on my view. Second is a call buyer always pay the premium. You can lose only what you have paid. In the case of call buyer, you are extremely bullish and you will lose only what you have paid. The profit will be unlimited. Suppose you bought a call at 100. Suppose you bought 16,900 call at 100. If market goes to 18,000, you will make almost 12 times of your capital. 17,000, you will make 12 times of your capital. Your option price will become 1,200. So your risk is limited and your profit is unlimited in the case of call buyer. I will again repeat it. Whenever you are buying a call, you are extremely bullish. You have paid the premium and lose only what you have paid, and the profit is unlimited. I'll come to the put buyer. You are extremely bearish. Suppose I'm expecting market to come to 15,000 again. If I bought 15,500 put, you are extremely bearish. You have paid the premium. That is, the a maximum amount you can lose. You have unlimited profit. Suppose the market comes to 14,000, your option price have become 1,500. So you have made almost 15 times of your option. So there is unlimited profit and there is limited risk. Again, there is a limited risk here. You will lose only what you have paid. Now come to the flip side. Come to call seller. You are moderately bearish. Or what do you mean by moderately bearish is a call seller. What they do is a seller of the call options. They are also called writers. That is, sellers are also called writers in the options market. Suppose the market is somewhere around 15,700 currently. I am not expecting market to go above 16,200. The market can come to 16,800. The market can come to 16,000, but I'm not expecting market to go above 16,200. And then on the downside, I'm not expecting market to go below 15,000 also. So what I will do is I will make a strategy. I will sell the call of 16,200. I will sell the put of 15,000 levels on the lower side. I'm expecting market to be in this 1,200 points range. At the time of expiry, what will happen is the 15,000 put or the 16,200 call will become zero. The market has not come to 16,200, that call option will become zero. And the put options, you have sold on the lower side, that will also become zero because it has not gone below that levels. So whenever, if the market blasts, if the market goes to 16,500, if the market blasts to 17,000, you will lose more than your capital what you have given. By selling 16,200 call, you would have get only 20 or 25 rupees of a premium. So if the market goes to 17,000, you can lose more than your 25 rupees premium will be now 800 rupees. So you wanted only 25, you wanted to earn only 25, but your premium have now become 800. So almost 500 times you are losing your capital. So whenever you are selling a call or selling a put, be very, very careful. Now come to the put seller. Put seller is moderately bullish because I'm not expecting market to go up drastically. I'm not expecting market to come down. So what I will do is I will sell the put. I'm not expecting market to come below 15,000. I will receive the premium and my profit will be limited to the premium received. And my loss will be limited, unlimited. My profit will be limited and my loss will be unlimited. So my gentle advice for the call buyers, call sellers and put sellers is always have a close eye on the market. You can lose more than what you wanted to earn. Suppose you wanted to earn only 50 rupees, but you can lose more than 500 rupees if there is a drastic fall in the market. In the past 2 or 3 weeks, you have seen 500 points gap down, 400 points gap down the market. Suppose Nifty was trading around 16,000 on Friday. If there is a Black Monday, and you are expecting market to go above 16,000, you are not expecting market to go below 15,700. If you have taken a 15,700 put sell on Friday, you are not expecting market to go below 15,700 at 50 rupees. But market had opened 500 points gap down. Now your 50 rupees have become 200 because it has opened below 15,500. Your option price is now 200. You are expecting only gain of 50 rupees, and you have loosened more than 4 times that. You are now losing 200 rupees on your trade. So whenever you are selling call or selling a put, be very, very careful, or always have a hedge on it. How to hedge it, how to do hedging, we'll do it in the next webinar. I'm just giving us a gentle advice, a gentle basic thing. Whenever you are selling a call or selling a put, do with a hedge. Don't go for naked selling of call. Even don't go for naked selling of put. If you want to go for naked options, always go for buy call or buy put. That too, not in huge quantity. Go for a less quantity if you are a new trader. Again, I will repeat, for a new trader, call option selling and put option selling is very risky. Don't go for this. You will burn your hands. And for a new trader, call option buying and put option buying can be advisable, but in less quantities, depending on your risk appetite. So again, I will repeat this slide. This slide is very important. A call option is bullish. He pays the premium. There is unlimited profit and limited risk. In the case of put buyer, he is extremely bearish. Extremely bearish means he knows he wants market to go down. Second is pays the premium, unlimited profit, limited risk. And for call seller, moderately bullish, receives the premium, limited profit and unlimited risk. And put seller, moderately bullish, receives the premium, limited profit. See, what we do is, I will give you a practical example. What do we do with our clients or our people who who do trade with us. We suggest them different kind of strategies. We do different kind of option selling, keeping a hedge on the market. If market open 1,000 points lower or higher also, will not lose much. We'll be in a particular range only. So whenever you are doing selling options, always have a hedge. If you want to do a buy options, you can do it, but do it with a less quantity. Selling options is also good, but you should have a counter plan with it. If the market opens lower, you should have a counter plan how we handle those options. So for a new trader, avoid selling options, always go for buying. And for an experienced trader, slowly, if you want to do, you can do it, but have a hedge. Now, this is the most important slide of this total webinar, that is moneyness of options. You would have known money. What do you mean moneyness is? In the money, at the money, and out of the money. Don't go for these three jargons. I will give you an example, simple logic. If you are in profit, you are in the money. If you are in loss, you are out of the money. And if you are in no profit, no loss, you are at the money. That is simple definition you can use. At the money is you are at no profit, no loss. In the money is you are in profit and you will get profit whenever you exit the options. After the money, you are in loss, you have to exit the option in loss. You should be very clear with these terms. At the money, in the money, out of the money. They are mostly called as ATM, ITM, and OTM. So you should be very clear. In the money is whenever you are in profit, you are in the money in options. Out of the money is whenever you are in loss, you are out of the money. And at the money is whenever there is no profit, no loss. This moneyness I am talking about only buying options. If you are buying option, if you are in the money, then it is well good. You are in profit. If you are out of the money, you are in loss. If you are at the money, you are in no profit, no loss. I will give a practical example of it. See, observe this slide. If the index is trading around at 15,500 levels, you can see here spot price is 15,500. Strike, if you have bought the call of 15,500, you are at the money. You are at the money because you are not having any premium. Your option will become zero because your market has expired exactly around 15,500. So there will be no profit. If you are bought at any premium, there will be loss and there will be the option will become zero. Suppose the market expired around 15,200 and you have bought 15,200 call, you are in the money because 15,200 value will be 300 and your cross spot price is 500, 15,500. So your option price of 15,200 will be 300 rupees. That is, you will be in the money. That means you will have some intrinsic value. Come to this one, the strike price is 16,000 and spot price is 15,500. You bought 16,000 strike call, but the spot price is expired 15,500. You are out of the money. Your option price has become zero. This is a basic you should know. Again, I will repeat it. If the spot price has expired at 15,500, you are having these three strikes. If you have bought 15,500 call, your call option will become zero. If you bought it with premium, you will have to bear that loss. If you bought a strike price of 15,200 and market expired on 15,500, you are in the money. You will make some profits depending on your buy price. If you have bought a 16,000 call, market expired on 15,500, you are out of the money. Your option will become zero. Should be very clear. This is all about moneyness. It depends on the strike and depends on what price you have bought. Now come to the put 15,500. If you have bought a put, the market is expired around 15,500, it is at the money. It will become zero if you have bought it at premium. If you are bought 15,000 put and market has expired around 15,500, then I think it is reverse. You will be out of the money because your strike price is below. So it will become zero. If you have bought 15,300 strike put and market has expired on 15,500, then also it will become zero. So your option, suppose this is 16,000 here and it expired on 15,500, you will be in the money. You will make around 500 rupees in that put. So always remember, if you have bought a call, your options, your strike price should be always lower than the current market price. If you have bought a put, if your option strike price should be always higher than the current market price. So depending on those things only, you should go and buy options. Again, I will repeat it. You will be in profit or you will be at least in less losses if your buying a call, if your option price, if your strike price is less than the current market price, if you are buying a put, your strike price should be always higher than the current market price. Then only you will be in the money. So this is all about moneyness. Now, what do you mean by valuation of options? The options are valued only by two things: intrinsic value and time value. So these are the two things which collectively parts comes together as a premium. Though there are only two things we should remember: intrinsic value and the time value. Intrinsic value is the total real value of the option. Time value will be eradicating as and when you come to the expiry. See, this is the best example. You can see intrinsic value of the option at the given point is the amount the holder of the option will get if he exercises the options. See, let's take example of 15,500 call. So when futures is trading around 15,400. See, if you have bought 15,500 call and current market price of futures is 15,400. So your intrinsic value is 0 here. Because your current market price is less than your option price. That means there is no intrinsic value. You don't know whether it will go above 15,500 or not. Whatever premium what you have paid is only the time value. There is no intrinsic value. Suppose futures is trading around 15,500, still your intrinsic value is 0 because it is not more than your strike price. Suppose it is trading on 15,800 and you have bought a 15,500 call, then there is a 300 rupees of intrinsic value. So you should remember, intrinsic value is if you have bought a call, if the strike price is more than your strike price of the current market price, then only there will be intrinsic value. If the current market price is less than your strike price, in the case of call, your intrinsic value will be 0. Again, I will repeat it. If you have bought a call, your intrinsic value will be having some value if your current market price of underlying is more than your strike. If your intrinsic value will be 0, if you bought an underlying whose price is equal to your strike price or below your strike price. So whenever you buy in options, keep this in mind: what is intrinsic value and what is time value. Now, what are the different kind of traders in derivatives or option market are? First are hedgers. I already tell you, most of the people who are in import-export business, who are into the currency business, who do deal in the foreign currencies, they hedge their portfolios by using derivatives. Speculators are the daily traders that, like you or me or anybody who are doing daily trading, they try to predict the future movement of the price and that they take position. Third are the arbitrages. Arbitrages is nothing but these are the people who wait for the opportunity where there is a very risk or no risk kind of trades. This kind of arbitrage will happens in exchange to exchange basis. And now there are many algos in the market, so there is very less opportunity to do arbitrage. So there are only three kinds of participants: hedgers, speculators, and arbitrages. Hedgers are the people who are dealing into the import-export business or any other business where they want to hedge their commodities or hedge their currencies. Speculators are the daily traders who do daily trading, like you, me, or anybody who want to do daily trade and expect the prices to fluctuate. Third are the arbitrageurs who wait for the opportunity to earn the risk-free profit. These three kind of traders are there in the market. Now, this is very important. Many people they do trade daily, but they will not see the contract note. Many people they know that the contract note will come to the mail ID or the phone at the end of the day. The option contracts on expiry are settled as per the closing price of the market in the cash. If the option contract expires in the money, then profit on exercising the contract will be credited. If the option expires out of the money, at the money, and the premium paid by the buyer will be given to the seller. Always remember, whatever option premium has been paid by the buyer is the income for the seller. So if you have bought an option at 50 rupees, that the 50 rupees is the income for the seller, the 50 rupees will be credited to the seller account. If that goes to 200, that 150 rupees will be taken from the seller account and it will be credited to your account. So always remember, options contracts, they are settled on daily basis, and the MTM, that is a mark to market, is done on daily basis and it will be settled at the time of expiry. So whenever you buy the options, always see whether it is in the money, out of the money, or at the money. If you are at the money or out of the money, your premium will become 0 and your premium will be given to the seller. If you are in the money, your premium will be taken from the seller and it will be given to you. So the settlements of future contracts, I already told you, daily settlement will happen and the final settlement will be done at the end of the contract. Now, this is very important. Many people, they do ignore it. See, whenever you buy an option, the premium what you paid is the margin requirement. But whenever you sell an option, your margin will be the total futures margin what is taken by the exchange. Suppose you bought a Reliance one future contract, you have to pay somewhere around 1.6 to 1.8 lakh worth of rupees to the exchange. So whenever you're selling the options also, suppose you bought a 15,500 call at 100, your maximum loss is around 5,000 rupees, sorry, 25,000 rupees. That is 250 into 100. But if you want to sell a 15,500 call, you have to pay total 1.8 lakh rupees to the exchange as a margin. You know, I'm not saying you lose to 1.8 lakh, but as a margin you have to pay whenever you're selling the options. So that is why people say in the market, whenever you're selling the options, you have to pay more margin, and whenever buying the options, you have to pay less margins. That is why whenever any research analyst or any people who analyze the market, they see what sellers are doing. They not see what buyers are doing, because sellers are the person who are giving more money and they are trading, who are giving more margin to the exchange, and that is why you can observe on television channels, you can observe anywhere in the market, the analyst or any other market fraternities, they will be always observing the call sellers or put sellers. They will not say that their put buyers are doing so, put sellers are doing this, put buyers are doing this. They always say that what put sellers are doing and what call sellers are doing, because those are the persons who are running the market. Call buyers and put buyers are very less because they buy just by giving some premium. But in the case of put buyers or put seller, they are giving the total margin. That is why whenever you analyze the market, analyze from the selling point of view, sellers of the calls or sellers of the put. You can analyze, you can go to any channel, they will be more talking about sellers rather than buyers, because they have given the huge margins. So always remember, if you are buying a 15,500 call at 51, you will have to pay only 2,500 rupees. But if you want to sell that option, you have to pay 80,000 rupees. That is the current margin. So there is a very huge difference between buying and selling of the option. Now, what are the disadvantages and advantages of derivatives? Advantages are this is a great instrument for hedging. There's high liquidity. The transaction cost is low. They can manage your portfolio very easily. Helps in price discovery, easy to trade, and there is less requirement. Disadvantage of derivatives is it is very high risk product. You can lose what you have more than what you have invested. It is highly leveraged. What do you mean by leverage is? It is a kind of loan. Suppose the contract value of Reliance is 8 lakh rupees. By paying only 1.6 lakh rupees, you are getting a future contract. That means you can lose more than 1.6 lakh rupees if you are trading in futures, or if you are buying, if you are selling any call or put. That is why it is highly leveraged and highly risky. There's a time decay factor. I already told you, if you are buying the options, always remember there is a time decay. Your option price will come down slowly, even there is no movement in the prices. There is no customization. If you're buying a futures, there is no customization. You have to buy the switches. You can't customize, like you can buy 10 shares, 20 shares, or 30 shares. You have to buy in lots. It is quite complex. I do agree. It is quite complex for a product. Many people, they don't have complete knowledge. Contract life is very less. It can be 1 month, 2 months, or 3 months. Different contracts which are there in NSE. Maximum contract price is 3 months. That is the 4 month contract. So only 3 months of period you will get. But in the case of equity, you can hold it for 10 years, 20 years, or 30 years as well. And there will be huge volatility. I already told you, post-corona effect, there is a huge volatility in the market, because many option players have come into the market, and many people, they started doing option trading in a very, very high manner. So I'll give you a live example or a real example. I used to observe the market in 2012, 2014. The open interest at the strike will was almost 20 lakhs, 25 lakhs of shares, 25 lakh shares. Now, if you see the weekly options also, more than 1 crore, 1.5 crore shares are open in various strikes. So many people, they have come into the market, they are now started trading it. So that is very harmful, and this will create huge volatility. That is why you can see during the expiry day or 1 day before the expiry, the volatility is somewhere around 400, 500 points in Nifty. This kind of volatility used to not get in the case of before corona effect. So there is a huge volatility in the market because many options traders or the options players have come into the market. So this is all about options. Again, I will repeat, I will give you a total update what we have discussed. In the case of derivatives, the two major contracts which are traded are futures and options. Futures are very easy to trade and they are not so complex. Options are a bit complex, and you should have a proper guidance or proper knowledge before going or trading into the options. There are two types of options: put options and call options. You buy a call option whenever you are bullish, and you buy a put option whenever you are bearish. Always remember, weekly options are only there for index, that are not there for stocks. Stock options only have monthly expiry, and futures, they don't expire weekly. Futures of any contracts, they expire monthly only. And you should remember three concepts: at the money, in the money, out of the money. If you are in profit, if you are buyer of a option, if you are in profit, you will be in the money, or if you are in loss, you will be at the money or out of the money. So this is the total crux of today's session. A small simple advice is, whenever you are trading in options, always select correct strike price, always have a stop loss and target. Don't wait for the option to become zero until and unless it has fallen because of news or because of any other effect. Don't wait for the option to become zero. Suppose you bought an option at 100, exited 50 or 40, keep a stop loss in mind. Also keep a target in mind, 180, 200 or 250, whatever target you have. Don't wait for the market to come and to take your erode your capital, because if the stock price don't move also, then also your option price will come down because of time decay. So remember, when you are trading in options, keep a stop loss and keep a target in mind. Don't wait for the market to erode your capital. And whenever you are selling options, always keep a hedge. Don't go for naked selling of options. It can erode your capital in a single day as well. And third advice is, if you are having any futures, long or short contracts, use options to hedge. Suppose I'm having a Reliance futures, but I'm expecting Reliance to come down. I'm having a long futures. I'm expecting Reliance to come down with market. What I will do is, either I will buy a put or sell a call to hedge. So you can also do this by using options and try to hedge your futures positions. So these kind of trades you can do by using options. So this is a small webinar what we have done, and we are trying to address what are the small jargons, what are the things you have to see by using the options, and what are the things we should not do with the options. And if you are new to the market, I will again repeat, if you are new to the market, don't go for the options trading directly. Go for SIPs, go for mutual funds, then go for equity market, then come to the options. And options also do with a proper guidance. Don't go for a naked option or don't go for naked selling of options. Do with proper guidance, do with proper hedge. So this is about all about today's sessions. If there are any queries, we can take it.
We will wait for a few questions. I'll just quickly check. Otherwise, thank you so much, Arun sir. Thank you so much for your insights and the flashing lights towards the topic. Even the big thank you for everybody who are attendees and attending this session. We are waiting for a few questions, Arun sir, 2 minutes. Okay. Explain. Arun sir, we'll wait for a minute for the questions. Maybe people can maybe type in the chat. Arun sir, a few questions in the chat box.
So there is a good question here, how to calculate time decay. See, there are various options, various tools which are there in the market. If you want to go for a calculation of time decay, I'll give a small example. A time decay curve is like whenever you are at the start of the expiry, the time decay will be very, very less. And whenever you are at the mid of the expiry, your time decay will start going faster. And at the end of expiry, your time decay will be very, very fast. So whenever you are buying an options at the start of expiry, your time decay will be very less. In the middle of the expiry, it will be moderate, and at the end of the expiry, it will be very, very fast. So always remember, if you are buying the option at the start of expiry, you are at a safer side. If you are buying the option at the end of the expiry, you have more chances of losing your losing the time very fast, because the time decay will be very less, and and the expiry is near, so time value will become zero. So how to calculate this? There are many option calculators available on Google. If you search on Google, you have to give 5 parameters, that is volatility, spot price, future price, time to expiry, and the strike price. If you type these 5 prices in the option calculator, you will get the time value and how much time decay will be there in the next few days. So that is very easy. If you just go to Google, download the option calculator, you can easily calculate the time decay. Which are the data from NSE can be used for option trading? See, my first and foremost thing is open interest. Open interest is the only thing which is very, very important whenever you are trading in options. Analyze the open interest, analyze the strikes where more people are trading. Always download a Baho copy. I don't know how many people know about Baho copy. There is one Excel sheet which will be uploaded in the NSE site after 7 every evening on every trading day. Download a Baho copy, download the FII statistics which are there in the NSE site. Analyze those things, how those people are doing option trading or how those people are doing futures trading. Even in our morning report also, even in our weekly report which we publish here with Google, you can go to those reports also. We publish the data. What FIs are doing, what is the open interest, where the open interest is getting added. So these are the 3 things which you can analyze. That is, first is open interest from Baho copy. Second is analyze the FII statistics from NSE site. Third is you can look for the FII F&O statistics as well, which is there in NSE. So these 3 files you can daily download. You will get these 3 files after 6:30 every evening on the NSE site.
Okay, so hope there are no more questions and all the queries got resolved by Arun sir. So thank you so much once again, all the audience and the attendees of the session. Please watch out for more sessions. Our upcoming webinar is on the way. Please follow us on our all social media handles where you'll get updates for our upcoming webinars. Even after this session, we are sending out a feedback form to you all, which will consist the topics that will be covered in the future. We would request you to please fill out that form and let us know how did we like the sessions about. Whether you can also reach out with us with our social media platforms such as Facebook, Instagram, and LinkedIn. For more queries and doubts, you can call on the number which we have put it on the chat box. Simultaneously, you can connect our customer support system from our website. Thank you so much for attending our webinar. And thank you so much, Arun sir, for your time and the insights towards the topic. Thanks a lot.